In 2026, the fastest way to ensure you stay broke for the rest of your life is to follow the most common piece of financial advice in history: buy a starter home. We are told that renting is throwing money away. We are told that a mortgage is a forced savings account. We are told that you need to get your foot on the property ladder as early as possible. This is not just bad advice, it is a mathematical catastrophe. The truth is, for the vast majority of people under the age of 35, buying a starter home is a decade-long wealth incineration event. It is a trap designed by banks and real estate cartels to lock you into a cycle of high-interest debt, transactional friction, and geographic immobility during the exact years when your capital needs to be the most aggressive. Today, I am going to prove to you that your starter home is likely the reason you feel financially suffocated and why throwing your money away on rent might actually be the smartest move you ever make. The reason you fell for this is rooted in a psychological phenomenon known as the endowment effect, combined with the sunk cost fallacy. From the moment you were old enough to understand the concept of a home, you were conditioned to believe that homeownership is the final stage of human evolution. This creates a visceral sense of fear of missing out. You aren't buying a house because the numbers make sense. You're buying it because you want to feel like an adult. The system exploits this biological need for territory to sell you a product that, in the first 7 to 10 years, is almost entirely a transfer of wealth from your pocket to the bank's interest margin. You feel the crushing weight of your monthly payments because the system was designed to keep you stationary. A stationary worker is a taxable worker. A stationary worker is a compliant worker. By tethering you to a starter home, the system ensures you can't move for a better job, you can't pivot your career, and you can't risk your capital on anything that doesn't involve a white picket fence. It is not your fault that you feel stuck. You were told to buy an anchor and convinced it was a sale. Let's look at the hidden math that your real estate agent and mortgage broker conveniently forgot to mention. We're going to compare two scenarios over a 7-year period, the average time someone stays in a starter home before trying to move up. Scenario A is homeowner Tobi. Tobi buys a $350,000 starter home in 2026. He puts 5% down, which is $17,500. He secures a 7% interest rate. Scenario B is liquid Larry. Larry rents a similar property for $2,200 a month and invests his down payment and the ownership surplus into a diversified index fund. Here is the brutal breakdown of Tobi's first 7 years. Down payment and closing costs, $28,000. Monthly PITI, principal, interest, tax, insurance, $2,800 a month, also $235,200 total. Maintenance and repairs, 1% rule, $3,500 a year, $24,500 total. Selling costs after 7 years, 6% commission, $25,000. Total unrecoverable costs, $312,700. At the end of 7 years, Tobi's house has appreciated by 3% per year. It is now worth $430,000. Tobi feels like a genius. He thinks he made $80,000 in profit. But let's look at the reality. After paying back the bank the $260,000 he still owes and paying the $25,000 in selling commissions, Tobi walks away with roughly $145,000 in his pocket. Now, let's look at liquid Larry. Larry took that $28,000 he didn't spend on a down payment and put it in the market. Every month, he took the $600 difference between his rent and Tobi's mortgage, plus the $300 a month Tobi spent on repairs, and invested it. At 8% return, Larry's liquid portfolio is now worth $186,000. Larry has $41,000 more than Tobi. More importantly, Larry's money is liquid. He can move to another state for a 50% raise tomorrow. Tobi is stuck waiting for a buyer, praying the inspection doesn't find a cracked foundation, and realizing that his investment actually cost him $312,000 in unrecoverable costs just to get a $145,000 check. Tobi didn't build wealth, he paid a bank and a realtor for the privilege of house sitting. Consider the real-world case of Tobi. Tobi is 31 years old. He bought his starter home because he didn't want to waste money on rent. 3 years into homeownership, his company announces a major restructuring. Tobi is offered a senior role in a burgeoning tech hub 3 states away. The new job comes with a $30,000 salary increase and equity. But Tobi looks at his house. The local market has cooled. If he sells now, after commissions and closing costs, he will actually lose money. He can't afford to sell, and he can't afford to carry 2 residences. Tobi turns down the promotion. This is the mobility tax. Because Tobi bought into the starter home myth, he has sacrificed his human capital for home equity. Over the next 5 years, that $30,000 raise he missed out on, plus the compounding growth of that income, would have been worth far more than the measly 3% appreciation on his suburban condo. Tobi is a victim of transactional friction. The system, the realtors, the banks, the title companies, strips 10% of your net worth every time you move. If you buy a starter home and then move to a forever home 5 years later, you have effectively nuked your wealth-building decade to pay for the lobby furniture of a mortgage bank. The reality check is this: a home is a service you consume, not an investment you make. If you want to build wealth in 2026, you must stop treating your primary residence as a piggy bank. The solution is strategic renting and aggressive liquidity. First, you must ignore the social pressure. If your parents or friends tell you that you are wasting money on rent, show them the math on front-loaded interest. In the first 7 years of a 30-year mortgage at 7%, over 80% of your payment goes to interest. You aren't owning anything, you are renting money from the bank. Renting a house from a landlord is often cheaper than renting the money to buy that same house from a bank. Second, you must calculate the price-to-rent ratio. In many major cities today, the cost to own is 40 to 60% higher than the cost to rent a comparable unit. If you take that 60% surplus and put it into assets that actually produce cash flow or grow, like stocks, bonds, or your own business, you will lap the homeowner every single time. Third, stay mobile. Your greatest asset in your 20s and 30s is your ability to pivot. The world is changing faster than ever. Industries are being born and dying in 5-year cycles. If you are tethered to a starter home, you are a dinosaur. Renting allows you to be the meteor. The starter home is a scam because it forces you to spend your most productive years servicing debt for an entry-level asset with high carrying costs. It keeps you poor enough to stay in the rat race, but settled enough to keep you from ever questioning the track you're on. You aren't owning a home, you are babysitting a bank's asset while paying for the privilege of fixing the roof. If you want to be free, you have to be willing to look like a failure to people who are broke. Real wealth is the ability to walk away from any situation. A starter home is the opposite of that freedom. It is a 20-year anchor in a 10-year storm. But the housing trap is just the first layer of the control mechanism. The same people who told you a starter home was an investment are the same ones who convinced you that a university degree was a guaranteed path to the middle class. If you think the math on the starter home is bad, wait until you see the 20-year break-even analysis on the modern degree. The system doesn't want you educated or housed. It wants you compliant and indebted. Choose your path based on math, not tradition, because in the new economy, the most expensive thing you can buy is a lie.